we need to talk about what Jerome Powell just said today, because he just started, in my opinion, a massive fire sale on the US housing market. And in particular, the people who really don't like what Powell said today are real estate investors. These big Wall Street real estate investors are now running scared. They're running for the hills, because here's what Powell said at Jackson Hole in Wyoming, that the Federal Reserve is going to maintain restrictive monetary policy for the foreseeable future. Specifically, projections show the federal funds rate running around 4% through the end of 2023. The Federal Reserve is now committing to not only continue increasing interest rates, they're committing to keeping interest rates elevated for the foreseeable future, which is going to mean that these real estate investors are going to be losing money in the housing market on their investments, and that they are going to have to fire sale their portfolio as a result. And as this video goes along, I'm going to explain to you all how bad this Fed-induced fire sale is going to be, and particularly the cities that are going to be most impacted by it. They're going to have the biggest inventory spike and the most price declines. But before doing that, it's important to understand fundamentally why these Fed rate hikes create such a big problem for real estate investors in the housing market. It has everything to do with the premium that investors get from renting out their property over the short-term interest rate that the Federal Reserve sets in America. Over the last year, the investor profit, or the cap rate in America, is about 4.5%, which was pretty good like in 2021 when interest rates were zero. But now that interest rates are projected to go to 3.8%, we can see that investors who buy real estate in America are basically getting very little premium over buying a short-term government bond. And that's a big problem, because the desirability of real estate as an investment vehicle is dependent on its cash flow, and in particular, its cash flow relative to other investment opportunities. And now we're entering an environment I want you all to think about where a big institutional investor or a smaller investor, maybe someone watching this channel, can replicate the returns from buying real estate simply by sitting on their couch and buying a 6-month US Treasury, which is of course going to mean that investor demand for real estate is going to continue to plummet. It's already started to go down. It's going to go down a lot more into the future, because what incentive does an investor have to buy into the housing market if they're getting no premium or no return for their efforts above the risk-free rate of a US government security? And as this investor demand continues to go down, home prices are also going to continue to go down in America, because in many markets, investors were a quarter of the demand, a third of the demand for homes over the last couple of years. And in some neighborhoods, investors were 50 to 60% of the demands. And so you all can understand this even better, let's play a game right now. I want you all to imagine that you're a real estate investor in America and that you're going to buy a house and rent it out. And I want you to think about what type of return, what type of rent and income you would want to induce you to do that. And as you're thinking about that, let's take a look at this listing in Dallas, which is on the market for $365,000. And we can see that if you bought this as an investor, you could rent it out for about $2,200 a month, according to Zillow, which would be $26,000 a year. However, you got to deduct expenses. Your property taxes are going to be about $8,000. Your insurance is going to be $1,500. You have maintenance, vacancy, utilities. And after all of that, your net income is going to be $14,000, or 3.8% of your purchase price. Now, does that 3.8% excite you? Does that entice you to want to buy real estate into a market where home values are going down? Of course not. Of course not. Especially when Jerome Powell and the Federal Reserve are aggressively hiking interest rates, which is why real estate investors are fleeing the market. But oh yeah, by the way, the more that interest rates go up, the more that mortgage rates go up, and the more that regular home buyers drop out of the market. So this is why higher interest rates, and this is why Powell's statement today about cementing higher interest rates into the future is a big, big problem for the real estate market, but it's the biggest problem for real estate investors. Is not only are they going to buy fewer homes into the future, they're going to be forced to sell their existing homes. Because what a lot of people don't understand, what I'm going to reveal to you right now, is the way that these investors buy the homes and how they finance them. Because a lot of people think it's cash, but folks, it's never cash. It's always a bank in the background giving these hedge funds and private equity funds money to buy single family homes. And this bank, they'll give these hedge funds maybe 70% or 75% of the money to go do it like a normal loan. The thing is, the loans that these Wall Street investors use to buy homes are often adjustable rate loans, where every time the Fed hikes interest rates, the Wall Street investor has to pay more in debt service and interest on their existing portfolio. And we're going to get to a a point soon over the next 6 months where these Wall Street investors are having to pay more to their bank and their warehouse lender than they're going to receive in income and rent from their tenant. Like literally, these Wall Street investors not only are going to see the value of their property going to go down, they're going to begin losing money in terms of cash flow because their interest costs are going up so much. And as that situation occurs and becomes more acute, some investors are going to choose on their own to sell out of the housing market. We're already seeing companies like Starwood Residential sell off big blocks of their portfolio. However, at some point, this is not going to be a choice that these investors are making because their lender, their bank, is going to do something called a margin call at a certain point where they're going to say, hey, Wall Street buyer who I'm giving money to, the value of the homes has gone down and now you can barely afford to pay interest. You're going to have to now just pay us off or pay us down. And when the bank does that margin call, these investors are then going to be forced to sell off their portfolio because they're going to need the cash, causing a massive widespread dump of inventory onto the US housing market, especially in the cities with the most investors and the cities with the lowest cap rates. We're going to see investors sell off in metros like Phoenix, Las Vegas, Atlanta, Jacksonville, Tampa, as well as others that I'm going to discuss later in this video. And I actually have personal experience with a margin call. At my old real estate company, we were a real estate debt fund. We had a relationship with a big bank who gave us money to invest in commercial real estate in America. And there was a certain point in 2018, 2019, the last time the Federal Reserve hiked interest rates, where they margin called us. They said, hey guys, this isn't working out for us. We have these collateral requirements. We have these liquidity requirements. Pay us off now. And when the bank said that, we had to do it. There was no if and or but about it. And I'm expecting these margin calls to start towards the end of 2022 because that's going to be when the rate hikes really start to get severe. And it's going to be at that point too that it's going to be obvious the rental market in America is declining. And this is a double whammy that a Wall Street investor can't deal with. They can't deal with at the same time their cost of debt and interest surging and then their rental income going down. But that's exactly what they're going to start to experience over the next 6 months. And again, this has everything to do with the Federal Reserve hiking interest rates and hiking interest rates way faster than these firms can react. But now this begs an interesting question I think a lot of you are already thinking about. Well, what's going to happen with inflation into the future? Because theoretically, if inflation crashes enough, we could see the Fed back off these interest rate hikes. We could see the Fed stop earlier than expected. And for a long time, I have been on the side of thinking inflation is going to come down and come down pretty fast. But now when I look at what, for instance, the federal government is doing, the Biden administration just forgave $350 billion in student loans, as well as another $150 billion in future interest payments, adding $500 billion to the U.S. debt and deficit. Of course, that's going to result in more consumer spending. That's going to result in a positive wealth effect that's going to cause a lot of the 40 million people who had student debt to start consuming more into an economy where we already have restricted supply that's causing prices to go up further. So net, this student debt cancellation is going to increase inflationary pressure into the future and make the Fed's job harder in terms of fighting inflation, which is likely going to mean they're going to need to increase interest rates by more and for a longer period than initially thought, which means anyone in the financial markets expecting some type of immediate relief from the Fed is going to be sorely disappointed. Powell is making it very clear that interest rates are going to go up and they're going to go up for the foreseeable future, which is going to cause big issues for the housing markets in red on this map. These are the ones with the lowest cap rates and the lowest room for errors with investors. Take a metro like Denver, where the typical cap rate for an investor is only 3%. They're only getting a $19,000 income on average for a $638,000 home purchase. Or in the Bay Area, in San Jose, the cap rate is a measly 1.6%, meaning investors already are earning less than the federal funds rate in San Jose, or in Portland, Oregon, where they're only earning a 2.7% cap rate. But once again, not all cities and housing markets are exposed to this Fed fire sale from investors in the same way. If we look, maybe you guys have noticed some of these markets are in green, particularly in the Midwest and the Deep South. We see there's higher cap rates, higher investor return, less of a risk that investors are going to stop buying and start selling, particularly in a market like Pittsburgh, where you have a listing here on the market for $180,000. The rental rate on Zillow is shown for $1,400 a month, meaning you could get $17,000 annually. After deducting all your expenses, you get $10,000 in income, which is a 5.8% cap rate, which still isn't a great return, to be honest, but it's way better than that property in Dallas we looked at earlier, as well as the other metros we've talked about so far. Now, before signing off, we need to talk about the stock market. The stock market is now crashing today as a result of Powell's words, and I want to explain to you why the stock market is crashing from a fundamental perspective. Because when we look at two lines here, one is the federal funds rate, the other is the dividend yield of the S&P 500. Basically, if you were to buy the S&P 500 index, how much do you get in dividends as a percentage of your purchase? And one of the reasons the stock market boomed in 2020 and 2021 was because the dividend yield of the S&P 500, around 1.5%, was higher than short-term interest rates. So basically said to people, why not buy stocks? Because even if they don't go up, you'll get a higher return through dividends than by buying short-term government bonds. However, now that the federal funds rate's to 2.3% and potentially 3.8% in the next couple months, it's going to be way more attractive for a lot of cash flow driven dividend investors to buy short-term government treasuries than to own stocks, which is going to cause the demand for stocks to decline and stock prices to crash. Now, I have two questions for all of you that I want to hear your answers to in the comments. Number one, do you agree with Jerome Powell's stance that we should hike interest rates more and keep those rates elevated for at least a year? Do you agree with that? And then number two, do you think Powell's going to follow through with it? I know a lot of people have questioned his resolve. So far, he seems like he's following through on his word. Do you think at some point, though, he might wobble and cut rates? Maybe Joe Biden at some point starts to lean on Powell and says, hey, cut the rates so the economy doesn't crash. Let me know what you think Powell's going to do in the future in the comments below. I came up with the cap rate data in this video by using home value and rent data from Zillow and combining it with property tax data from the US Census Bureau. If you want access to that data, hit the join button below and become a channel member. I'll be sending email updates to my channel members soon with interactive access to those maps.